Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited to have with us today, Karl Krauskopf. Karl, welcome back to the show.
It is so great to be here. Third time's a charm. It is exciting. We're closing some deals, and it's just always great to chat with you, Whitney.
Yeah. Well, and that is the important thing that I want to pull out here is that deals, even in this environment, are still getting done. So guys, listen up and learn. So let's talk about, well, actually, before we talk about Eastmont Townhomes, your 33 units that you just closed in East Wenatchee, Washington, for those of us who didn't hear the first couple of sessions, tell us a little bit about yourself, how you got into multifamily real estate and where you're at today.
Sure. So where we're at today, 85 units, about $25 million assets under management, all in the Washington State region. Currently, I live in Seattle, Washington. I was a corporate strategy chief of staff for a healthcare company for about a decade before starting my business as a full-time endeavor 3 years ago, and it's been great. Started off small multis, started in getting into the single-family home flips, fix and flips, then ground up construction development of townhomes, infill development in downtown Seattle, and quickly thereafter moved over into the multifamily buy and hold, and that's where we're at now.
Awesome. Well, let's uncover what you did with Eastmont Townhomes, 33 units, East Wenatchee, Washington. Karl, when did you close on this deal and what was the purchase price?
Sure. So we closed on June 10th, and we bought it for $6,375,000.
Okay. So how did you find this deal? Was it on
Yeah.
market, off market?
Good question. So off market, and which was great. It allowed us, we really don't see any significant or really any meaningful discounts for off market, of this size. I think what we really won in terms of, what we got in exchange for going off market were negotiations, ability to negotiate our terms, right? So length of feasibility, inspection periods, finance contingencies, et cetera, which just allowed us to, again, move a little bit more fluidly, a little bit more confidently throughout the deal cycle, which was great. How we got the deal, again, off market, was brought to us by a broker. A broker contacted us because we own another asset in the city, Evergreen Developers, which we talked about maybe it was about 18 months ago. Anyway, that project there is what I would call an heirloom property. It's not historical. Doesn't have any historical designations, which is good. But it is heirloom in the sense that it is, it does have quite a bit of history. It's a charming gem, if you will, in the city, and a majority of the people that own real estate, especially in the multifamily side, know that building. Gorgeous Bavarian style architecture, and yeah, we've owned it for about close to 2 years at this point. And when I go through meeting with just random people through the public market, Pybus Market, and in public when I'm out there in Wenatchee, is we talk about it, right? We talk about what I'm doing, what I own, and a fair amount of the times, some of the older generation people, they know exactly which building that we're talking about.
All right. So off-market deal, was there any competition?
No, no, there was no competition. I know that the seller had tried to sell it for quite a bit higher the past year, and just nothing ever came to fruition. So I think he decided to come to terms with where he thinks that the market may have been. We ended up buying it at about, I want to say it was a 5.5 or 5.6 cap rate. And yeah, the seller just wanted to get out of it, and we got him at the right time.
Gotcha. Okay. So when did you walk the deal?
I walked the deal in December of 2023, kind of
Okay.
between, mid-December.
Okay. And did you walk all the units at that time or just do a preliminary walk?
Good question. So I only walked one of the vacancies. There was only one property that was vacant at the time. The building had historically, almost no vacancy. We could talk about why, but only walked one unit at that time.
Hmm. And how did you get it under contract? How did you structure the deal?
How did I structure the deal? It was it's a good question. So single asset, right? Single asset syndication is how we structured it. We structured it with a 45-day feasibility period, 60 to 90-day, I think it was 90-day finance contingency, some closing after that, and then an option to extend as well.
And did you have earnest money down on the deal? And was it hard?
Good question. No, the earnest, well, yes, I did have earnest money. Earnest money was about 1.5% of the deal, of the purchase price. And the money did not go hard until we released the feasibility.
Gotcha. Okay. Now what was the overarching business plan? Why were you attracted to this project?
Yeah, super low rent compared to market. The great thing is that I had operated in the market for about a year prior to even looking at this property. So I knew what a one bedroom would rent for, what a two bedroom, three bedroom, and four bedroom would rent for. So when I saw the average rents, the average rent per square foot of this building, I was like, this is actually makes a lot of sense, even at a 5.55 cap in this market. Um, Now, why I was attracted to it was for the rents as well as a lot of the townhomes. You looked at the unit mix, right? Two bed, 1.5 bath townhome. They're all townhome structured, which is another thing I liked. I also liked that it was 1977 build, so relatively newer vintage. And one of the big things is this was a two bed, 1.5 bath townhome that was 1,800 square feet. So my first thought was, is there any room, is there any ability to add living square footage and add additional bedrooms and bathrooms to this to make it more appealing from a rental standpoint? So the very first thing I did when I toured that first unit was I went and looked for that additional square footage, and lo and behold, there were 20 of the 33 units had below grade, or rather daylight basements that were all unfinished. And so that is a huge part of the business plan, is going in and finishing out those daylight basements to go in and add convert from two bed into four bedrooms, and instead of 1.5 bath, go to 2.25 bath. So add a ton of value into the units themselves.
Now that's very interesting because it sounds like more like what somebody would do with a single family property, like in a burr.
Yep.
So I'm curious to dig in a little bit on your due diligence on this. Something that comes to mind is, did you have the egress ability to convert it into those additional two bedrooms in the basement? But also, like, what kind of CapEx budget did you put to this project? So let's
Yeah.
dive into the physical due diligence.
Yeah.
What what happened there?
So keep in mind, prior to jumping into the multifamily side of things, I did a ton of single family home remodels, and a lot of what I would do in the Seattle space was converting those daylight basements and finishing out the basement space. And so that was already something that I have done a significant amount of times, right? 30, 35 times over the last just few years. And I'm very, very comfortable with that. Not only the process, but also in underwriting the expenses around it. And so, the CapEx, to answer that question, is we're looking anywhere from, depending on the unit size, anywhere from 35 to about $55,000 per unit. And that's going to include finishing out the basement, as well as all of the, your typical cosmetic updates, converting from carpets to LVP flooring, kitchens, baths, all that kind of good stuff.
Interesting. Okay, so a little bit larger CapEx budget
Yep.
for our
Yeah,
project
we're
with
about
this.
probably about 1.5 million.
And with those two additional bedrooms going in the daylight basement, do they have egress?
Yes, absolutely.
Okay.
I
Okay.
mean, 100% they have to. So the majority will have a full daylight, meaning we could even put a door for them to walk out of. We just won't put a door, just because having a door in a bedroom doesn't really make a whole lot of sense.
All right, all right. Any other surprises on the physical due diligence on the property?
I don't think any negative surprises. I think, a couple things that were unique about this is the size of the property, the size of the landscaping itself, something I am not personally, I've done most infill deals, so not a whole lot of landscaping. This one is about on an acre of land, and so huge space, from a due diligence standpoint. I think one thing that we missed on the front end is just the requirement to essentially water sprinkle this place. They do have a sprinkler system. We found out after the fact that the sprinkler system is not fully operational, so we're having to do a little unforeseen repairs there, which in the end is not that much money. And in fact, what we're working on now is hardscaping as opposed to landscaping, just to also reduce the OpEx. If we're going to put in CapEx already into the exterior of the buildings, we might as well just hardscape it, keep the OpEx low. I think one other thing that has come up during the maybe you could call it the physical inspection or physical due diligence period is what the bigger play with this whole community is not just buying and holding it and renting it out and then selling it as a single asset, but more importantly is what I liked about this is that they were all townhomes. And so what are we going to do with townhomes, and how do townhomes sell? Townhomes sell really well individually. So how, one of my other thoughts besides, how to finish out the basements was how if is it possible to sell these townhomes individually? So take it from a multifamily, strip it for parts, and then sell them as essentially single families. So we went through a couple different options there. Condo conversion was the simplest. Also a little bit on the riskier side from a developer liability standpoint, construction defects. But what came out through the process of meeting with the city planner, the economic team as well, was that they are adopting a code that would allow us to do essentially a zero lot line subdivision of those units, so that way they can be sold separately. There's no HOA involved. It's simply just what you would expect a traditional townhome community to sell and operate as.
Interesting. That is very interesting. And are there shared walls here?
Yep. Shared walls, townhome style. Yep.
Okay. Well, let's switch to the financial due diligence, right? Because you said that it was only one unit available for you when you walked in December, which is highly unusual for a multifamily complex. Tell us what the play was here and what did you find?
Yeah. So the property itself had what I found that there was several different expense line items that were just exorbitant. First and foremost, the previous seller had a property management company, which is fine, but they also had an on-site manager, which was essentially making 6% of gross income. So their blended rate for management on a 33 unit was 11%. So they were paying 11% management fees between on-site and professional third-party management, which again, I have been running a 30-unit complex in the same city, essentially. And I know obviously my expense on the management side is much less. So that was one area of opportunity that I knew I could bring expenses down pretty quickly and easily. Insurance seemed radically exorbitant. We were able to get about a third of what they were paying before. They were paying something like $33,000. When I had conversations with them, it sounded like they were wrapping in umbrella insurance and a few other non-property related insurance products that we didn't see that we necessarily needed for this level of product. And then, from a rental standpoint, I think the biggest opportunity there was that, again, I've operated in this market. I know what the rents should be. We are about 40, upward of 60% on some of the units below what they could be rented without a renovation. And so what we did is, really project out what it would look like if we just increased rent without necessarily renovations. What is the renovation premium? Is it worth the squeeze? And so that's where we decided, the renovation plan does make sense, especially if our business plan calls for the unit lot subdivision or the conversion into individually deeded townhomes. So we're really excited about that. One anecdotal story is that a tenant who has been in there since 1996 had their original lease was $685. Their current lease right now is $985. So over the course of I don't know, what is that, almost 30 years, they've only gone up $300. And this is one of the large 1,800 square foot townhomes.
Well, 67 or 77. I think we're cracking on like 40 years there.
Yeah. No, 1997.
97. Okay,
Yeah.
perfect. Okay, yes, I will give you that. About 25 years there. There
Yep.
you go. So,
Yep.
okay. Well, how did you finance the deal?
Good question. So there is a credit union. We've got one of what I would call a unique product, 15 years fixed rate, 15-year fixed rate loan, amortized over 30 years. We've got 24 months of interest only payments, and there is no prepayment penalty. Yeah, so gives us a ton of interest rate is 7.5%. Not too bad. It's just the way that I look at it is it provides the best of both worlds. It provides the flexibility, allows us to either refinance or sell it, day two effectively, or have the predictability of what it would look like in 14 and a half years, of what the interest rate would look like in 14 and a half years. So gives us the best of both worlds, predictability and flexibility.
Now, I'm gonna ask a question because if you have this type of loan and you start parceling off each of the units individually, what how does that affect the loan?
Yeah, good question. So we worked with the lender, and the big thing is working with them on full and partial reconveyance. So as we go through the sale of these townhomes, essentially, is that on the front portion we're going to be paying off the loan itself on a full reconveyance basis. Now, sure, that doesn't necessarily give us the sheer flexibility if it was a partial reconveyance, where let's say we're getting 20% of the proceeds is cash, as opposed to paying down the full loan. I would say that that's a little loss on flexibility, but certainly gives us, certainly is support. The business plan is supportive of it, and it still works for us.
Okay. All right. So you said you raised capital for this deal. Tell us how you structured this with your investors.
Yeah. So what is it? 72, 28% LP to GP split. So limited partners get 72%. There's a 7% preferred return. We raised about $2.9 million on it. And, really the idea there is that, hey, I think the proposal is that we're in and out in 3 to 5 years, closer to the 5 year. But there's a real clear path to completing this renovation, this lease up, and then the sell off in 2.5 to 3 years, and that's the business plan that we're pushing for pretty aggressively.
Okay, and then are there any other general partners on the deal?
Yep. So there's a couple others. My typical go-to general partner, Augustus Bukowski. He and I have partnered on several of our other multifamily deals, as well as some single family homes. And then there are 2 or 3 others, and they're folks that I've worked with quite a bit in the past. Folks that are in the market, in the Wenatchee market as well, and they're great.
Awesome. All right. Going back to the capital piece, you talked about, having your preferred return and your other split. Are there any other like tranches here in the capital stack, or in the waterfall, I should say? And then what kind of fees did you charge to the deal?
Yeah, so we are 2% fees overall. For the sponsor fees, asset management fee is a little bit on the higher side, but it doesn't really kick in until after the stabilization. So asset management, I want to say, is 4%, which is, I'll admit, higher than what we would typically see. But given that again, that does not kick in until stabilization, which is about month 18. If you blend it out, it's like 1.8%, if we were to be taking it from the get-go. Um, let's see what else. Sponsor fee with 2%, asset management fee. What was some of the other questions? Oh, other tranches. So we've got a class A and a class B investor. A class B essentially is an investor who brings in a little bit more capital to the deal, and in return is given essentially a 10% premium or 10% bonus to their equity. No additional seniority in terms of payouts or anything else like that. There's no IRR hurdles, no performance hurdles or anything like that. No uncapped returns either.
So on the asset management fee, is it 4%? Are you doing a construction management fee?
Yes.
The construction.
That's all wrapped into that's good question. Great question. So that's part of the 2%. So 2% is the full sponsor fee. It's inclusive of the acquisition fee as well as the construction fee.
Gotcha. All right. Well, what did you find during this process that you thought was going to be easier, but actually ended up being more challenging? And then what ended up being more challenging that you thought honestly would be easier?
Yeah, good question. So I would say the capital raise on this was a little bit more challenging than expected. Right, raising 2.9 was quite a bit more than I had about 1.2 million more than I had raised on my past deals. Also, considering when we started raising earlier this year, when essentially you're getting risk-free capital for minimum 4.5%, upwards of 5% via money markets. I say risk-free, but ultra low risk money, 4.5 to 5%, and essentially painting the picture that yes, that while that is great, 4.5 to 5%, there's no upside associated with it. There's no tax advantages associated with it. Um, and it's just battling the liquidity of it as well, right? Those money markets, you have ultimate flexibility in terms of liquidity. So I would say that was probably the most difficult part of the whole situation. And then I would say the easier part is likely going to be and will be both the construction as well as the actual unit lot subdivision. So the process that I described is being able to sell off the townhomes individually. We're doing this process on our other Wenatchee 30 unit, on 6 of those. And, it's going really well so far. The market's receiving the affordable housing very, very well. And that's how, we're going to be positioning these townhomes as well as, something that, something that should be trading for 27% higher than what we anticipate them selling for.
Awesome. Well, Karl, thank you so much for sharing your knowledge and expertise with us here today. If people want to connect with you, how can they do so?
Yeah, great question. Gold-mf.com and LinkedIn are certainly my two preferred places to connect. LinkedIn is just my first name, last name, Karl Krauskopf. That's going to be a doozy to spell. There's not many of us out there, but if you can figure out how to spell it, you can definitely find me there.
Awesome. Well, Karl, thanks again for being on our show with us here today and spending your time with us. We look forward to hearing about your future deals.
Love it. Thanks so much, Whitney.